All right, well, good afternoon. We're going to go ahead and get started. Thank you for joining us for KSM's 2025 year-end tax seminar. I'm Ryan Miller, a partner in KSM's Tax Services Group, and I'll be leading us through our topics today. And 2025 has been another year of change in the tax world. Kind of change and uncertainty seems like the only constant in recent years, but 2025 saw the passage of significant tax legislation that's commonly referred to as the One Big Beautiful Bill, which is generally referred to as OBBB or even OB3 for ease of conversation. But this is the tax reform legislation that was signed into law on July the 4th, and there are significant tax changes for businesses and individuals to consider as a result of OBBB. Okay, we have a team of professionals with us today to cover some of OBB's most significant changes, as well as a few other topics to help you plan for year end and 2026. But before we get started, we need to cover a few housekeeping items. First, this webinar is being recorded, and the recording will be emailed to you early next week. Second, you'll notice we have turned on the Q&A function in Zoom. If you have any questions during the presentation, please use the Q&A feature. We'll try to answer them at the end of the presentation, but if you submit a question and we are not able to respond, please know that we will contact you directly after the event. Now, most importantly, this webinar does qualify for CPE. We use the Conferences.io platform instead of polling questions to track attendance. So please log in using the QR code shown on the screen or navigate to the Conferences.io web address listed in the first bullet point and choose the tax update session. You can access this either on your phone or on your computer. So while using the Conference.io, you will first check in and then enter the code words that appear in the slides throughout the presentation. You must attend the webinar for at least 125 minutes and enter at least 8 of the 10 code words into the Conference.io to receive full credit. Okay, don't forget to, or please remember to select checkout in the Conference.io at the conclusion of today's webinar. Certificates will be emailed from our learning management system in the next few weeks. And with that, we are going to get going with the presentations. So here's a quick preview of the topics we'll be covering today. And yes, we do plan to cover it all in less than 2.5 hours. We'll see how we do. The first several presentations cover topics impacted by OBBB. There are key business changes to depreciation, interest, and research expenses, new deductions for tips and overtime. We're going to give you a little background on qualified small business stock and qualified opportunity zones and discuss OBB's impact on those incentives, as well as OBB's impact on charitable giving and estate and gift tax planning. Then we dropped in a little refresher regarding the federal deductibility of meals expense. The change here relates all the way back to TCJA, but here we are, getting ready for 2026, and there's a little change to discuss with respect to meals. Finally, our state and local tax folks will reset the ever complex state landscape, including OBB's impact on state conformity laws, as well as a sales tax update. And then we'll have a few miscellaneous topics to close us out. All right, before I hand things off to the first speaker, let's practice getting our first code word in, which you'll see on the screen now. It is code word 171. If you have any issues, feel free to send questions via the Q&A function, but it's code word 171 is our first code word to enter into the Conference.io platform. Okay, let's go ahead and get started. Code word number 1 is 171. All right, and getting started today, we're going to kick things off is Tim Mosier, a director in KSM's Tax Services Group. He's going to run us through the big three of bonus depreciation, the deductibility of interest expense and research expenses, along with an exciting new cost recovery provision. Tim, the floor is yours.
Thanks, Ryan. We're going to kick things off by initially talking about qualified production property. We'll also refer to it as QPP. What's unique about QPP is that this is something that's really brand new. A lot of the things that we're going to talk about today are more of extensions or enhancements of maybe existing policies, but QPP is something we have not seen before. So what we're referring to is the ability to elect 100% bonus depreciation for qualified production property. In the news, this was referred to a lot as, the ability to deduct manufacturing facilities. So we'll break down on the following slides what exactly is qualified production property. Before we do that, though, I do want to hit on some important dates that we have to watch out for. So we're looking for things that are placed in service between July 4th, the signing of the bill, and before January 1, 2031. So we've got a placed in service date that we're watching, but there's also a construction period that it has to begin during. And one thing to note here is that the rules for looking at the construction date require us to look at when you had a binding contract. So if you're someone who's started a project in 2025, that would be something you'd want to look at to see if you fall in that window or not. So what is qualified production property? We're talking about non-residential property used by the taxpayer as an integral part of a qualified production activity. So non-residential used by a taxpayer, and it has to be an integral part of a qualified production activity. We'll break each one of those down on following slides. It also has to be in the US or in the possessions. The original use has to begin with the taxpayer. So what this means is if you purchase an existing manufacturing facility, that's not going to qualify. There is a carve out though, if you were to buy a building that hasn't been used as a manufacturing facility, and then you repurpose it for such a purpose, that could work. Beyond what I went through on that previous slide, the law doesn't really define QPP. It really focuses more on what's not QPP. So you'll see on the screen here, they're trying to carve out areas that maybe kind of go along with the manufacturing facility, but are not specifically manufacturing. So administrative spaces, parking, sales areas, research areas. So it's going to be interesting. As I mentioned, this is something brand new. We don't have any guidance on, okay, well, most manufacturing facilities are not just, super clean where you walk, everything's perfectly bifurcated and you walk from one area to another. So what's the guidance going to look like as far as how you break those things out? And then I think we're also going to have more guidance here on, warehouses, for example, is, a raw materials space considered an integral part. So that'll be a key area to look for when the guidance comes out. The other thing I want to highlight, and this is really important, is that this does not apply to non-residential property depreciated by a lessor. So if you are renting manufacturing space, neither you nor the landlord are able to take this deduction. I want to note here that there's no specific exception for self-rentals. So for a variety of tax and legal reasons, clients often set up a separate entity from for the real estate and a separate entity for the manufacturing space. Based on what we know today, it doesn't look like that would work. So if you're in the process of a project now, if you're getting ready to start a project, you'll want to take a close look at the way that it's being structured. There's not a lot of guidance on what qualified production activities are. It has to be tangible personal property, and the law also says that it has to have substantial transformation. I think this will be another area where we're really just gonna have to wait and see what the guidance says. Thinking through the clients we work with, we've got a lot of clients where it's gonna be very clear cut, this is definitely manufacturing. There's definitely substantial transformation. But, what about things that are closer to like light manufacturing, assembly? Where does that line get drawn? And we just don't really have a great answer for that yet. All right, so we're gonna move on now to bonus depreciation. Um, so kind of more good news here. 100% bonus depreciation has been reinstated for property acquired after January 19th, 2025. Similar to what we talked about with QPP, there is that requirement to look at the date of a written binding contract. So kind of the key thing takeaway here would be, you can't just look at all your assets placed in service in 2025 and assume that you're going to get bonus depreciation on everything. It's going to require some analysis of contracts in some situations. There's also an optional election. So for some taxpayers, they may not want 100% bonus depreciation. They can opt into 40% bonus depreciation. Section 179 also saw some enhancements. So the total expense amount goes up from 1 to 2.5 million. And there's also an increase in the phase out. This applies for tax years beginning after December 31st, 2024. So 2025 calendar year taxpayers. All right. We'll switch gears a little bit, get away from depreciation in section 179 and move to section 163J. For those who are not familiar with this, this is the code provision that governs the ability to deduct business interest expense. So as a part of TCJA, they created a new limitation that limits the amount that's deductible. And here's an illustration of how this has kind of evolved over the last few years. When TCJA first came out, the limitation was based upon EBITDA. So you got an add back for your depreciation and amortization. That was 2018 to 21. And then in 22, we flipped to looking at EBIT. So for a lot of taxpayers, this was a big swing, resulted in disallowed business interest expense. And what the bill did was it permanently changes the definition back to EBITDA. So we'll be back to the 30% of EBITDA in 2025. So another very favorable provision for taxpayers. We'll pause here for a second. This is code word number 2. Make sure you enter in 226 to get your CPE credit. All right, reminder one more time, get that code word in there. It's 226. All right. So the next topic we're gonna jump into is section 174. So for those who are not familiar with section 174, this is the code section that provides the rules for how you're supposed to treat research and experimentation or research and development expenses on the tax return. And to kind of fully appreciate where we're at today, we're going to do a very small history lesson on kind of where we've been, and that will better illustrate why the OB3 changes are significant. So prior to 2022, you could really deduct research expenses, you could capitalize research expenses. There's a lot of flexibility for taxpayers, and it had been that way for, I don't know, more than 50 years. Well, as a part of TCJA, as a revenue raising provision, they snuck it in there that beginning in 2022, we would have to capitalize research and development expenses. It was something that we didn't really think was going to go into place. We thought they'd change the law before 2022. And then, despite numerous attempts, they couldn't get it done. So For tax years beginning after 12/31/21, the rule has been that you've had to capitalize domestic research expenses and amortize them over 5 years, and then it was 15 years for foreign expenses. So we've been through 3 years of that, and then OB3 brought us some relief. So beginning for calendar year 2025 taxpayers, you can deduct domestic research expenses. Additionally, you can also deduct the unamortized 174 costs from the earlier years. And you've got the option to do that in 25 or split it between 25 and 26. And then there's also a provision that allows eligible small business taxpayers to amend tax returns. So that is a lot of information. I think over the next few slides, we're going to go kind of through some more practical things to consider and how we apply these rules. Unfortunately, there's a lot of things to think about, but I think, just kind of high level, keep in mind that this is really good news for taxpayers who were affected by it. Yes, there's some questions that we got to work through and how it's best implemented for each taxpayer. But these are good questions. These are good problems to have. This is really a big benefit for companies. So first, we'll talk about 2025 in more detail. So the first thing I want to highlight here is that you'll note on the screen, we say domestic expenses. So the extent that you have any foreign research expenses, whether it's foreign employees, foreign contractors, those are still subject to capitalization and amortization over a 15-year period. So I would say most of our clients don't have a large amount of these expenses, but if you're one of the ones that do, you want to be aware that this still applies to you. Sorry, having trouble with the slide there. Oops. And then I don't think a lot of taxpayers are going to take advantage of this, but there is still the optional election to capitalize and amortize research expenses, which when you kind of, can be a very valuable tax planning tool if you need it. On the next slide, we're going to jump into how we deal with the unamortized costs from 22, 23, and 24. Had a little trouble with the slides here. There we go. So there's three options that are available to taxpayers. The first option is that you can deduct the remaining expenses in the 2025 tax year. So whatever that unamortized amount was at 12/31/24, you get to deduct it in 25. Option two would be that you split that deduction equally between 25 and 26. And then there's the third option where you just continue to amortize those costs over the remaining life of the asset. What I want to point out here, and we're going to dive into this in more detail, is that a lot of times we kind of default to the idea that it would be better to have more deductions today. But there's a lot of reasons why it might make sense to apply options 2 or 3. Unless you're a C corporation, there's different marginal tax rates. There's a lot of other provisions affected by the bill. So it does require some analysis to figure out how are we going to apply this in the way that's most beneficial for each taxpayer. Before we get more into the details on kind of thoughts behind options, also do want to highlight that if you're a small business that's an eligible taxpayer, you can elect to file amended tax returns and go back and deduct your expenses on your 22 to 24 returns. So eligible taxpayers, this definition is based upon 2025. So we're looking for businesses that have less than $31 million of gross receipts based upon a 3-year average. So for normal calendar year taxpayers, that'd be 22, 23, 24. To the extent that there's businesses under common control, you do have to aggregate those and look at that threshold as one. as one business. So for taxpayers that meet this criteria, this could be a very, very beneficial option. So what are some of the things that we're thinking about as we advise our clients on how to implement this? We're thinking about ownership changes, whether you've recently had a transaction, whether you expect to either have new shareholders partners enter or have shareholders partners exit. You want to think about how that deduction is going to be treated, make sure it's very clear who's going to benefit from it. Keep in mind there's different marginal tax rates, especially with 100% bonus depreciation coming back. There could be some kind of odd swings in how taxable income might look. So we'll illustrate that point here in a little bit more detail as well. And then you want to just more broadly think about how this would also impact other tax provisions. We also note that we typically try to stay away from creating big losses, as those can be subject to income limitations in future years and kind of some other reasons too. So to try to help illustrate this, we've got a very basic example here of, what's the difference between taking the deduction all in 1 year, and then what if I spread the deduction over 2 years on the right there? And the result is, a fairly significant amount of difference in tax where you're actually better off in the 2-year option rather than the 1 year due to the marginal tax rates. So again, there's a lot of factors to consider. These decisions impact other things on the tax return, but really just trying to show you that, the 1-year option is not always going to be your best option. So if you're a small business taxpayer and you're like, hey, this is great news, I want to go back and amend, we're going to tell you to think through all the things that we just talked about, but then also consider a few other items. So you want to think through, is it practical to amend my tax return? It's very different from an effort from a cost perspective if you've got 2 shareholders that file in one state versus, if you've got 10, 15, 20 partners and you're filing in 30 states. That's going to have a big impact. We're also telling clients, hey, we don't really know how long it's going to take for you to get your refund. We've had clients waiting multiple years on refunds, so we're not super confident that you're going to see this in a very timely fashion. You might be better off taking the deduction in the future years and, reducing your estimated payments going forward. There is interest on claims depending on the structure. Certain partnership returns won't receive interest if they're subject to the BBA rules, but this is one of the primary reasons why you might want to make an amended return is, if you had really big income years, you paid a lot of tax, you might be better off going the amended return route. And then there is one change on how this impacts the research credit, that if you go back and amend, the research credit maybe becomes slightly less valuable. We'll talk through that more in a few slides and try to illustrate that as well. I'm going to step back, giving you a lot of things to think about. If your company is impacted by this, I think kind of the things that you would want to take away from this is, hey, I need to get my arms around it, take kind of my next couple of years projection of income and think about what's the best way for this to be applied. And then from there, you can consider the impact to estimated payments. So I've had numbers of clients who went through this exercise and they said, hey, I can, significantly reduce my estimated payments for the rest of the year, or maybe even skip them, depending on how big of a deduction this was for them. I'd also give a plug that if your business is a C corporation, there's a special refund procedure that applies to C corporations where you can make a quick refund claim, and the IRS actually has an obligation to process it. And I can't remember if it's 45 or 60 days, but that would get you your cash back much faster than if you wait until you file your return and you request a refund. So great option there for C Corps. Anytime I talk about Section 174, I always get the question of like, how does this impact the R&D credit? And the answer is, largely it doesn't impact the R&D credit. It doesn't change what qualifies. It doesn't change the eligible expenses. It really only impacts one area, and that's what we call 280C. And effectively, 280C makes you take into account the fact that you're getting a credit and a deduction, and you either have to reduce the credit or reduce the deduction so that you're not getting kind of a double benefit. And the way that this used to work was you had two options. You could claim the full credit and increase your taxable income by the amount of the credit, or you could take a reduced credit and not change taxable income. If you're a C Corp and you have a 21% tax rate, assuming it doesn't impact any other provisions, you basically end up in the same spot outside of state taxes and some other things. But there was a period of time, so 22 to 24, where you could, in a lot of cases, take the gross credit and not have to make any adjustment to your taxable income. So instead of your credit being worth $79, it was worth $100. As a part of OB3, they largely went back to the old rules with some slight modifications. And they said, so this will impact everybody going forward. But they said if you go back and amend your returns, the small business taxpayers, you have to apply these rules retroactively. So this does impact the research credit, and then it makes it slightly less valuable. But I just want to be super clear, like if you're claiming an R&D credit, like it's still going to make sense to claim an R&D credit. This does impact it, but it's still a great benefit. It might just be one reason why you did choose not to go back and amend. So one last slide that I just want to get people thinking. If you've had transactions or you are considering transactions here in relatively soon, you'll really want to make sure you understand how this expense is going to be treated in a transaction. You don't want a scenario where you think the seller thinks they're getting it and the buyer thinks that they're going to get it. It's really important that this is addressed. And just want to note that this law applied retroactively. So if you had a transaction in the first half of the year, this was probably not something that you're thinking about. So better to kind of get it on the radar now and start thinking about it before you get into tax season. So with that, I'll give it back to Ryan Miller. Thank you.
Great. Thanks a lot, Tim. Appreciate that. So you're going to be stuck with me a couple different times today, including for the next section. All right. Couple slides there. So the next section is the new individual deductions for overtime and tips. This has gotten a lot of attention and press coverage. These are the deductions that originated during President Trump's campaign as the no tax on tips and no tax on overtime proposals. So it got a lot of press coverage. It's kind of catchy, I guess. But lo and behold, they did get a limited version of these concepts into the new tax bill. And while these provisions do not provide any direct tax benefit to the employers, they're not business deductions. There are new payroll reporting requirements that are important for businesses to pay attention to and make sure they are ready for. So to get started, the two provisions have a lot of similarities. This slide applies to both the deduction for overtime and the deduction for tips. And it's important to note that these are employee level individual income tax deductions that will be claimed on individual 1040s. They are temporary, 2025 through 2028. They can be claimed without itemizing. They're subject to income phase outs, you'll see on the next slides. And married taxpayers must file a joint return. The deductions are not available to married filing separate taxpayers. From an employer perspective, on the business side, the overtime pay and tips are included in the employee's taxable W-2 income, the same as they always have been. They're subject to payroll tax withholdings, Social Security tax withholdings. These amounts are not exempt from income tax, and they're not exempt from payroll withholding taxes. Again, these are not exemptions. These are deductions that are determined at the employee level. But where this does impact the employer is that employers will need to track qualified overtime paid and qualified tips that are included in the W-2s, so the qualified amounts can be separately reported to the employees. Now, the service did issue a news release in early August confirming there will not be any changes to the 2025 information returns. So the actual W-2 reporting for 2025 is the same as it's always been. No changes to the forms, no changes to the withholding tables for 2025. But the August news release left unanswered, how are employers supposed to report these amounts to their employees for 2025 and still be in compliance with the new reporting obligations? So the IRS then issued notice 2025-62. This was issued on November 5th, so just at the beginning of this month. And the new notice provides penalty relief. So the notice provides that no penalties will be assessed for failing to separately report qualified overtime and qualified tips for 2025. The IRS is providing some breathing room here to employers, providing more time to ensure systems are in place to separately report these amounts starting in 2026 for the 2026 reporting. Now, the notice encourages but does not require employers to provide employees with a separate accounting of the amounts along with the occupation codes for tips. But again, this is not required for 2025. And since it's not required, there are some commentators kind of cautioning businesses from voluntarily providing the information if there's any uncertainty regarding the amounts. You don't want to provide incorrect information when it's not required. So now, as we sit here on November 20th, we still need more guidance. In particular, how will individuals determine their deductions if a separate accounting of the information is not provided by the employer? Or will there be a grace provided to employers that voluntarily provide the encouraged information if they provide incorrect information? The notice does say that additional guidance is forthcoming, particularly with respect to the individuals claiming the deductions, but for now, we have to wait and see. In any event, one word of caution, one takeaway is to make sure your payroll folks have a plan for capturing these amounts, qualified tips and qualified overtime. The separate accounting will certainly be required as part of the 2026 information returns that'll be filed in January of 27. But ultimately, this is a payroll reporting issue. So, discussions with your payroll folks and your payroll provider, if you use a third-party firm, is prudent. Okay. All right, so deduction. This slide has more information specific to the overtime deduction. So the maximum deduction is $12,500 or $25,000 if it's a joint return. And you can see the deduction phases out when modified AGI exceeds certain thresholds. But an important question here is the definition of qualified overtime. So qualified overtime is overtime that is required to be paid by Section 7 of the Fair Labor Standards Act. So overtime pay that FLSA does not require is not qualified overtime for this purpose. If the overtime is paid pursuant to a labor union agreement or a specific state law requirement, such as California's daily overtime laws, that isn't, if it's not required by the FLSA, it's not going to be qualified deductible overtime for this purpose. And only the amount in excess of the individual's regular rate constitutes qualified overtime that could potentially be deductible. So the example here is an employee that's making $20 per hour. They work one overtime hour at $30. The qualified overtime is $10. The extra 50% component is not the full $30 the employee was paid for that one overtime hour. So the employer in this example, starting with the 2026 reporting, will have to separately report on the W-2 that there's $10 of qualified overtime included in their W-2. Yeah. All right, and this slide has a little information unique to the tips deduction. Here, the maximum deduction is $25,000 for a single and a joint return. And the income phase out starts when AGI exceeds 150,000 single, 300 joint, the same starting point for the phase out as the overtime deduction. And qualified tips for this purpose are cash tips only that are paid voluntarily with the amount determined solely by the payer, so no consequence for non-payment. This does include tips paid in cash and charged, and it does include tips received under tip sharing arrangements, but something like a service charge, for example, is unlikely to qualify in this case because the service charge is mandatory. It's not an amount that's voluntarily paid and determined by the payer. So that's some basic guidelines. Qualified tip income is limited to tips from occupations that customarily and regularly receive tips prior to 2025. And the occupation has to be listed on the IRS provided list. And the service did issue proposed regulations in September to help define qualified tips. And those proposed regulations included a list of qualifying occupations and assigned a Treasury tipped occupation code to each occupation. So for example, bartenders are on the list. We could have all predicted that. And they were assigned a TTOC of 101. Wait staff is a code of 102, so on and so forth. At the moment, there's 68 occupations on the list. So in 2026, if you're an employer that's including qualified tips in an employee's income within the context of a qualified occupation, you'll have to report the qualified tip amount and the TTOC code to the employees. And I'll note that tips while working in a specified service, trade, or business do not qualify. So sorry, accountants, lawyers, doctors, performing artists, we can't claim any of our income is by way of tips. So that was a quick overview of the new deductions for tips and overtime, and in particular, trying to get employers and businesses to be thinking ahead for making sure they can report these amounts to employees when that reporting requirement kicks in. So I'm going to turn it over to Jacob Whitey, a partner in our business advisory group, and he's going to talk to us about qualified small business stock. Jacob.
Awesome. Thanks, Ryan. Good morning, everyone. Like Ryan said, I am Jacob Whitey. I'm a tax partner here at KSM that leads our technology services practice. Today, I want to dive into one of the most powerful and really often underutilized, I'd say, provisions in the tax code for entrepreneurs and investors. Section 1202, better known as the Qualified Small Business Stock Exclusion, or QSBS. So at its best, Section 1202 can allow shareholders to exclude up to 100% of capital gains on the sale of qualified stock. And with the One Big Beautiful Bill, or OB3 as we're calling it, coming into effect in the middle portion of this year, these benefits are now enhanced. So starting off, well, before we get to the basics, let's get our next code word in. Code word, or the number, is 453. So I'll leave you waiting. I'll leave it up there for a second. Again, 453 for the code words. All right, like I said, I kind of want to start with the basics of 1202, or just some background on it, for those who might not be familiar with QSBS. At a high level, if you hold stock in a qualified C corporation that meets certain conditions and you hold it long enough, you can potentially eliminate tax on the gain when you sell. So there are strict entity and shareholder requirements that we'll get into on the following slides. And really, QSBS, it's been around since many on this call were in the workforce and maybe even before some were born. But it really gained new life after the 2017 Tax Cut and Jobs Act that lowered the corporate tax rate to 21%. So this drew more interest and tax efficiency to C corporations. And now with OB3, we're seeing expanded thresholds, shorter required holding periods, really creating a perfect storm of opportunity for entrepreneurs and investors. So as I mentioned, we kind of have two tranches, right? We have to make sure that the entity qualifies and that the shareholder does as well. So let's start with the corporate side or the entity requirements. Because if the entity isn't qualified, nothing else really matters. So as we can see up there, it must, to issue QSBS, it must be a USC corporation, so not a partnership or S Corp. Note that an LLC that checks the box to be taxed as a C corporation, that can't qualify. The stock has to be originally issued to the shareholder directly from the company. And even more importantly on that point, we'll cover it within the shareholder requirements on the following slides as well. It must meet the gross asset test in order to qualify. Pre-OB3, that was a $50 million gross asset threshold. Now with OB3, that increased to $75 million. And we'll get into more on the comparison of the changes on the following slides with regard to OB3, but that's one of the main changes. At least 80% of the assets must be used in an active trader business. And really, when vetting stock for QSBS eligibility, this requirement is often the one that requires the most attention. It really requires a deep dive into the facts and circumstances, including best understanding the various revenue streams and just overall business activities of a company. So for excluded industries, think farming, banking, consulting, really anywhere where the business is based upon the reputation or skill of an employee. So think accounting or legal. And to that point, kind of a general rule is that an activity should qualify, even if it involves providing products and services to businesses engaged in those excluded activities. So think of a technology company that serves a legal industry or legal tech, though that would still qualify. Final point there, watch out for stock redemptions. They can easily disqualify the stock. And really, the main point here is that if you have a qualified small business and are interested in doing a stock redemption or otherwise want to, just be sure to consult your tax advisor to avoid a pitfall there. Moving along to the shareholder requirements. So I mentioned we have two tranches, right? We just discussed the entity or corporate side of things to determine, do we have a qualified small business? Once we have cleared those entity requirements, we now know that. So from there, we need to think about the shareholder requirements to really secure the ultimate tax benefit. So you must be an individual, trust, or state, not a corporation. So anyone other than a C corporation who is subject to U.S. capital gains taxes, when that QSBS is sold, they could benefit from this 1202 QSBS gain exclusion. Pass-through entities like partnerships and S corporations, they are eligible owners as well. But really that should be done with the assistance of a tax advisor because those rules can get complicated and should be done with care to preserve the full exclusion, especially when you might have shifting interest within that pass-through entity. The 5-year hold, the stock must be held for more than 5 years for the full exclusion, and OB3 changed that a bit, which we'll get into on the subsequent slides as well. The direct issuance requirement or original issuance requirement, so it must be acquired directly from the company, not secondhand, I'll say. And QSBS purchased from a stockholder, that'll lose its status because it fails that original issuance requirement in the hands of the buyer. Exceptions to that original issuance requirement include QSBS transferred as a gift or at death or through a distribution from a partnership. And then QSBS can be also issued in exchange for services, so not necessarily in exchange for money or other matters. So one key building point off of the previous points, I'll say, is in the context of equity-based compensation or stock options, restricted stock, et cetera, as well as convertible debt or similar investment vehicles, because when converted to stock, these could qualify. However, it's just important to remember that the holding period would not commence until the stock is actually held. So, for example, the hold period for convertible debt won't commence until the conversion date. Or if the QSBS is restricted, so restricted stock subject to vesting, at the time of issuance, the employee's holding period won't commence until the QSBS vests. So that's important to think about when thinking about, hey, how long do I have to hold this thing to get the benefit? Final point on this kind of sub-bullet, I'd say, is that I did not mention safes above or simple agreements for future equity. We've certainly seen those as a bit more popular now. And is it debt? Is it equity? So I think just kind of the caveat there is if you have a safe and are reviewing that timing of your 5-year window, review it with your tax advisor and understand the risk of the IRS viewing that as a hybrid instrument that's not really stock. So again, it's important to understand, when does that hold period actually begin? And final point here, no offsetting short positions or hedges are allowed. So if those boxes are checked that we've just talked about and listed, you're well on your way to qualifying for this QSBS benefit. So now that we kind of best understand or refreshed on, what is QSBS 1202, I want to talk about the changes under the One Big Beautiful Bill, or OB3, which were effective on that July 4th date. So as you can see, the three categories that change within QSBS or requirements are the gross asset cap, the gain exclusion, and the holding period. So as I mentioned previously, it was a $50 million gross asset cap pre-OB3, and now post-OB3, it's a $75 million cap. And as you can see on the slide, that's indexed for inflation, and so will change and increase over time. The gain exclusion amount that I mentioned earlier, right? We have what I'll call a standard cap pre-OBB of $10 million, or 10 times your basis would be the gain exclusion amount. So at a minimum, you're getting a $10 million exclusion, and then or 10 times your stock basis from there. So the standard cap increased to $15 million post OB3, while they also maintain the 10 times your basis. So now that with that standard cap increasing, obviously it creates an even more enhanced benefit. And that number, the $15 million number, will also be indexed for inflation. The holding period, it's still a 5-year hold to get the full 100% exclusion. However, now we have this tiered structure, right? We have a 3-year hold for the 50% exclusion, or a 4-year hold for the 75% exclusion. So really, the OB3 makes QSBS more flexible and more valuable, right? It allows earlier exits while still preserving partial exclusion, and raises the limit to really just reflect the modern business growth, since the $50 million cap had been in place for some time. I'll say the timing of issuance is key. We received some clarifying questions when this initially came out in terms of the tiered structure, but just again, important to note that July 4th date. So stock issued on or before July 4th follows the old rules. Stock issued after that date, that's when you get the higher caps and tiered benefits. So all that really creates I'd say a crucial planning window for companies considering reorganizations, rounds, conversions, or taxpayers that might be considering gifts to maximize that increased standard cap. So now that we know, again, what QSBS is, or reminded of it, know some of the enhancements under OB3, what do I do with this? Where do I go from here? What should I be doing with this information? Potentially reevaluating your entity structure, right? For high growth ventures, a C Corp may now make more sense, especially post OB3. And it's important to remember that anything mentioned here, reorganizations, mergers, recaps, it can taint QSBS status if not structured correctly. So just make sure that all that is done with care. Kind of along those lines, I'd say a frequent question I get is, can a partnership or LLC convert to a C corporation and still qualify? And the answer is yes. And again, of course, with planning, when you convert, the stock is treated as newly issued on the date of conversion. And that's when the 5-year clock starts. Or now under this new instance, the clock, is attainable at the 3 or 4 year mark as well. And this is key, the corporation at that point must meet both the gross asset test based on value at the date of conversion and the active business test at the conversion as well. And in this context of a conversion, any gain that existed before conversion won't qualify for exclusion. So really just the growth and value, is what can be excluded. So planning takeaway there at a high level is if you think your partnership has real growth or exit potential, convert early, start that 5-year clock, lock in QSBS eligibility, and again, just consult your tax advisor early and often. There are opportunities to convert from an S corporation to a C corporation. But that should be done with care and, without merely revoking your S election. It's the devil's in the details in terms of how ensuring it's structured properly. What else should I be doing? Well, incorporate QSBS into your investment strategy. The analyses of after-tax returns should incorporate this new guidance, certainly. The increased threshold may also have an impact on how mergers and acquisitions are structured. For example, lower mid-market M&A deals, private equity buyers might be more inclined to structure their acquisition vehicle as a C corporation as opposed to a partnership. Because really this enhances the overall investment opportunities. The higher asset threshold means a larger number of small businesses can qualify for QSBS benefits. And this expansion allows PE firms to consider a wider range of investment opportunities, including slightly larger startups that were previously ineligible. With the reduced holding periods and increased exclusion caps, these firms can realize substantial tax benefits more quickly, as can the founders. And this makes investments in small businesses more attractive as a potential for higher after-tax returns increases. Note also, it's interesting that the 3-year holding period for that 50% exclusion that I mentioned on the previous slide, it coincides with the 3-year holding period for carried interest. So it kind of shows the alignment there within those investment opportunities in those two portions of the tax code. Something abundantly important too, in terms of where do I go from here, especially with increased benefit, is monitor compliance, right? Taxpayers should maintain what I would call a QSBS file that tracks asset levels, business activities, shareholder eligibility every year, including documentation of subscription agreements, property contributions, equity grant agreements, corporate tax returns, corporate financials, because as with anything, concurrent documentation is the best. And with how large this benefit is going, you want to make sure that you're ready, have it documented both for yourself and for anyone potentially looking to come into your cap table, should you be one of those qualified small businesses. One of the other bullet points up there, just as a reminder, any portion of the gain that isn't excluded is taxed at 28%, not the 20% allotted to other types of capital gains. So that's an important item to remember as you're thinking about updating those investment analyses. So really overall, success with QSBS, it's all about planning. So plan your entity structure, time your issuances, be deliberate about conversions or capital raises, and, of course, consult your tax advisor through all that. And the rules around QSBS, they still lack a lot of full clarity. There's really not too much guidance around any of these rules. So it's abundantly important, especially in this context, and given the magnitude of the benefit, to always document and stay in contact with your tax advisor on these matters. So appreciate your time today, and I'll hand things back to Ryan.
Great. Thank you, Jacob. And, 1202 can be very powerful, but as you explained, very complex, very nuanced, careful planning and consideration is required. And our next topic is very similar to that. Very same thing, can be very powerful, but also very complex. We're going to turn it over to Jake Shadone. Jake's a director in our real estate services group, and he's going to give us an overview of qualified opportunity zones and OB3's impact on those real estate incentives.
Thank you, Ryan. Hello, everyone. Happy to be here today. My name's Jake Shadone, director in the real estate services group. And as Ryan alluded to, we're going to be covering QOZs, a little bit of a reminder for the 1.0, and then some information regarding the 2.0 qualified opportunity zones that the One Big Beautiful Bill enacted. And before we jump in, next code word is 642, or code number 642. Okay, so for 2026, we wanted to put reminders in regarding while there is a lot of excitement over the QOZ 2.0, QOZ 1.0 is still in effect, and maybe one of the biggest takeaways from today's presentation over QOZ is a reminder that your deferred gains that you have under the 1.0 are going to be recognized in tax year 2026. That means, for a simple example, if you have deferred, say, $1 million of gain over the last couple of years into QOFs, that $1 million of gain will be recognized in tax year 2026. This is regardless of if the investment is sold or still held, and the amount recognized is the lesser of the deferred gain or the fair market value of the QOF investment at that time. We don't anticipate really many decreases in fair market value, so the general expectation should be that your gain will be equal to the deferred gain that you originally invested into the qualified opportunity fund. So some potential adjustments to the gain: if you've held the investment for the last 5 years by December 31st, 2026, you will get a 10% basis increase. So again, keeping the $1 million example, if you had deferred $1 million and you've met that 5-year period, your deferred gain would be increased in basis by $100,000. So your gain recognized would be $900,000. And then if you've held it for 7 years, that's a 15% adjustment. Last bullet point: income is treated as being earned on 12/31/2026. And I'll get into that in just a minute as to why that is an important consideration. So planning for 2026. Your recognized deferred gains cannot be rolled into a new QOF for additional deferral. This is probably sad news to a lot of our clients, but it's it's not as easy as saying, hey, I now have $1 million of gain that I'm recognizing, and that's gain that I'm just going to roll into a new QOF under 2.0 or something like that. Doesn't work that way. It's going to be recognized. So really, we have to look at other planning opportunities. So first, you should definitely be consulting your tax advisor to make sure you have a general understanding of what your deferred gain is, the character of the gain, whether it's long-term or short-term, and your projected tax related to that gain. And obviously start planning for your needed liquidity to pay those taxes for tax year 2026. If you are a real estate developer, for example, you can try to time your recognition of the gains with other losses. So for example, if you're a real estate professional and you're placing in service a new apartment complex in tax year 2026, could be a great time to perform a cost segregation study to try to accelerate some of that depreciation in tax year 2026 to offset some of that income that you're going to be recognizing from your recognized QOF deferred gains. Another planning opportunity, though probably a little less applicable, would be if you're going to recognize this income in 2026 and that pushes you into a higher tax bracket, you could consider trying to recognize ordinary income in 2025 or 2027 rather than 2026, if those years would be a lower tax bracket year, purely because of that gain recognition pushing you into a higher bracket. As noted, start planning for the needed liquidity, and this is where that 12/31/26 date is important, because that means your tax payment, depending on your quarterly estimates and when you're paying, it's either going to be January 15th, 2027 or April 15th, 2027. As noted, the old rules 1.0 goes through 12/31/26, and the new rules go through start January 1st, 2027. And then we'll touch on just a little bit later, a little overlap that applies to 1.0 and how that could shake out. So now all of the amazing updates from 2.0 for the One Big Beautiful Bill. Overall, a lot of the changes are beneficial to a lot of our client base, and really it seems to have simplified and made planning a lot easier for these types of deals, the QOZ deals. So the One Big Beautiful Bill reshaped the OZ program from a time-limited incentive, so through January 31st of 2026, and now has turned it into a permanent planning opportunity a permanent program for our clients to take advantage of. There's now going to be a 10-year rolling designation period. So what that means is starting on July 1st of 2026, state governors can start to propose the census tracts to the Treasury Department for certification. And then effective January 1st of 2027, that will be in effect for 10 years. And then that redesignation cycle will continue at the conclusion of each 10-year period. So this allows for a lot of great planning opportunities for our clients, because now you have 10 years of certainty of what these tracts will be. Some additional changes, there will be stricter eligibility criteria for the QZ designation. So there's some changes in the different median family income cannot exceed 70% of the applicable state or metro area median family income, which was previously 80%. And parcels that are next to or have been piggybacking off of QZ tracts will no longer qualify. In addition, there's now this new rolling 5-year gain deferral and a 10% basis step up. Again, this is a new point of the 2.0 that probably favors the taxpayer and tax professionals in being able to really have a great planning and understanding of how these gains are deferred and when they're recognized and when there's an adjustment to the gain. So now gains deferred or invested after 12/31/26 will be deferred for 5 years with a 10% basis step up achieved at the 5th anniversary. So this means only 90% of the deferred gain would be recognized. There's no, as you saw on a previous slide, there's a 5-year and a 7-year consideration. Now it's just 5 years, and that achieves a automatic 10% gain exclusion. So again, it's 5 years rolling. There's not hard dates like we have under the 1.0. There we go. Another huge change out of the 2.0 are the rural QOFs. So now we have the Rural Qualified Opportunity Funds, which allow for a 30% basis step up after 5 years rather than the 10% that I just mentioned. And in addition, you only have to have a substantial improvement of 50% if you're acquiring property within a rural QOF rather than 100% substantial improvement. This is great for obviously rural clients, and the designation of a rural area is, as you can see here, it's a city or town with a population greater than 50, or defined as any area other than a city or town with a population greater than 50,000 in an urbanized area adjacent to a city or town with a population greater than 50,000. So another new opportunity for our clients to explore additional benefits outside of the typical metro area, such as downtown Indianapolis. So some additional changes under 2.0, the gain elimination frozen after 30 years. So under the current 1.0, there is a potential that, or prior law require that investments to be sold by 12/31/2047. But under the 2.0, there is no requirement for such sale. Instead, it freezes that gain exclusion based on the fair market value after 30 years. So if you invest in 2027, 30 years later, you do not have to sell that asset anymore. Instead, your exclusion is set on that fair market value after 30 years. So if you continue to hold it for another 20 years and it increases in fair market value, there will be gain to recognize and gain that will be taxable on that 20-year difference. But the 30 years up to that, that's where you get to freeze your fair market value. And then in addition, there's new information reporting and penalties for non-compliance. So the whole impact of this is to make the investments in QOZs more transparent, provide more oversight, and really be able to track the economic impact of the QOZs. I think in the tax professional world and the developers as well, there's probably a mixed opinion as to the actual impact of QOZs under 1.0. The goal here would be we're going to have better data to actually show how these the tracks are working, if these investments are leading into positive economic impacts, and so on. The non-compliance can result in significant penalties. So it's important that you're working with a tax advisor who understands the QZ, QF structuring very well, and that you're getting your tax advisor involved early in the process to make sure everything is going as it should be. And sorry, I just see my slide didn't move forward for that last one. Okay. So planning opportunity, right now, the real consideration is, should QOZ dollars be invested in 2026, or should you wait until 2027 to tap into the benefits of the 2.0? Mainly being you would get the 10% basis step up for the 5-year hold period if you wait to invest in 2027 under the 2.0. And then lastly, the unknown. So under 1.0, under 2.0, there's still a lot of gray areas. KSM is continuously tracking all the different changes and updates that come out regarding QOZs. There's information that we need more clarity on that has not been included in this presentation. For example, there's some uncertainty over certain classifications for Puerto Rico and different timing deadlines for the QOZs in that area. But right now, this is one of the main unknowns, is how the expiring QOZ designations under 1.0 will affect the investments in these areas. So for example, for a zone that will expire in 2028. So this is the slight overlap that I talked about on the very first slide. While it expires, 1.0 expires 12/31/2026, there's now this old loan or the old law zones, the zones don't expire until 12/31/2028. So what does it look like if you're investing in a 1.0 and then that 12/31/28 timeline starts to approach? Are there going to be special rules regarding when the project will need to have begun or when it needs to be completed? And if so, how does all that work to actually be able to qualify for that specific project? Again, this is not the only unknown, but it's one of the more significant ones that we're currently tracking at this moment. So that is it for today's presentation on QOZs. Again, I encourage you to speak with your tax advisor if you know you're going to be wanting to take advantage of the 2.0, or if you are concerned about 1.0 and wanting to get a better feel on your projected tax liability as those gains are going to be recognized. Definitely encourage you to reach out sooner rather than later. Appreciate your time, and I think I'm going to hand it back over to Ryan right now.
All right, thanks a lot, Jake. Both 1202 and QOZ can deliver some powerful tax benefits, but they're both very complex, require careful planning and the right set of facts to fully benefit from it. So thank you both, Jacob and Jake. All right, I'm doing the next section too. We have yet another aspect of our tax slides impacted by OB3. We have tax law changes impacting charitable giving. These changes can impact individual donors, both itemizers and non-itemizers, and can impact corporate donors, so C corporations, of course. And these changes go both directions. There are some taxpayer favorable changes that are expanding the tax benefits of charitable giving, and there are some new limitations to consider as donors plan their charitable giving strategies. First, we got a code word. All right, code word number 5. Yes, we are aware it's a code number. Type in 729, the numbers 729. Code word number 5, 729. Give you a minute. 729. All right. And first, back to charitable giving, a little bit of good news. You know, it's not huge dollars, and we'll see throughout that the general impact of these charitable giving provisions, they're generally not huge dollars, relatively speaking. So keep the dollar impact in mind as you consider these changes and you're planning around it. But anyway, the first change here is to allow non-itemizers to claim a modest charitable deduction starting in 2026. So individuals who claim the standard deduction, so they're not claiming itemized deductions, can claim a deduction of $1,000 on a single return or $2,000 for a joint filer. And this applies to cash donations made to public charities. So contributions to supporting organizations, donor advised funds, private non-operating foundations, they're not going to qualify for this new deduction. So, you know, we do have a lot of individual taxpayers, you know, globally speaking, the majority of individual taxpayers claim the standard deduction. The standard deduction amounts are relatively high now since TCJA and have been made permanent. And you combine that with the cap on state and local tax deductions when you claim itemized deductions. And a lot of people claim the standard deduction. So while the benefit here is relatively modest, this will provide some benefit to a lot of individual taxpayers as they claim standard deductions and still make charitable contributions. Okay. Try to get the slides to advance. There it is. All right. Itemizers, individuals claiming itemized deductions instead of the standard deduction are going to have new limitations imposed on their charitable deductions. And first, starting with 2026, there's going to be a 0.5% of AGI haircut applied to their charitable deductions. So total charitable deductions must exceed 0.5% of AGI before there's a tax benefit to the charitable contributions. Again, the dollar amounts are not huge. We'll see an example in a minute where a $1 million AGI results in a reduction of $5,000. It's not huge reduction in relative to that amount of AGI, but it's noticeable. It's something to consider and try to plan around. On the favorable side, for taxpayers making large donations, the ceiling limitation of 60% of AGI was made permanent. And this applies, again, to cash contributions to public charities. And it's the 60% AGI ceiling. Keep in mind, there are other ceiling limitations for non-cash contributions and contributions to private foundations. There's a 50%, a 30%, and a 20% ceiling limitation. But this 60% that's applied to cash contributions made to public charities is now permanent. And there is a carry forward for disallowed charitable contributions, but it's a little weird now. If you have an amount disallowed by the ceiling limitation, then both the amount disallowed by the new 0.5% floor and the amount disallowed by the ceiling carry forward for 5 years. However, if you're not subject to the ceiling limitation, then the amount disallowed by the new floor limitation does not carry forward. It's just a permanent disallowance. So kind of a weird little carry forward rule now. And that's the new floor. There's also a new overall limitation on total itemized deductions starting in 2026. This overall limitation will only apply to individual returns with taxable income in the highest tax bracket, so in the 37% tax bracket. The math behind this limitation works to limit the value of itemized deductions to 35%. So instead of the itemized deductions offsetting 37% income at a 37% benefit, the benefit's going to be kind of capped at 35%. So it's just a 2% reduction in the benefit of itemized deductions for those individuals, and only for those individuals that are in the highest tax bracket. Again, the benefit of itemized deductions is only being reduced to 2%, so not huge dollars, but it is noticeable. And again, it can be meaningful at the higher dollar amounts. So there is some thought here to at least consider the timing of any planned contributions. You can discuss numbers and projections with your KSM contact or with your personal income tax advisor. But the question between now and December 31st is whether it makes sense to accelerate planned 2026 contributions into 2025. We're going to talk more about that here in a couple slides. And before we get to the strategies, here's just a quick example regarding the new limitations imposed on individual itemizers. The first two columns just show with and without the new limitations for a married filing joint return with $1 million of AGI and $50,000 of charitable contributions. You can see in the middle column, starting in 2026, the charitable contribution deduction will be reduced to $45,000 because of the 0.5% haircut. And the overall itemized deduction will be reduced by $2,973. The math equals a reduction of 2/37 of total itemized deductions. And you can see in the footnote, the reduction is the lesser of 2/37 of your total itemized deductions or 2/37 of the amount of taxable income that's in the highest tax bracket. So the new limitation in this example causes taxable income to be $7,973 higher, which equates to an additional income tax of around $3,000 if the income is ordinary income. The right column shows the impact at larger amounts. So here, taxable income is $155,946 higher because of the new limitations. Now we're talking about additional income tax of $58,000 if this is ordinary income, but if it's offsetting capital gain income, it might only be a $38,000 benefit. But in any event, you can see the numbers start to get pretty meaningful as AGI and total deductions get higher. Quick comment about C corporations that make charitable contributions. They will need to reduce their charitable contributions by 1% of taxable income. So the individual haircut we just saw is 0.5% of AGI. C corporations also have a new haircut of 1% of their taxable income. The 10% ceiling remains unchanged with the same 5-year carry forward rules that we mentioned earlier. And of course, it's always important to consider if it's a true charitable contribution subject to these limitations, or is it a sponsorship? Could it possibly be advertising expense? Those sort of regular trade or business expenses that are not subject to the charitable contribution limits. Oh, another code word here. So code word number 6 is 575. Code word number 6 is 575. 575. Okay. All right, 575. Moving on. Just a couple comments about strategies here. The first one is grouping or bunching deductions into a year. For example, do you want to accelerate a planned 2026 contribution into December of 2025 to avoid the new 0.5% AGI haircut and the new overall limitation? We saw in the example, depending on your AGI, the dollar amounts may not be huge here, so you will want to consider the time value of money. We had one example where the commitment was a December 2026 contribution, and accelerating the contribution a full year may not make sense. You may be better off collecting your interest or your investment income for the full year and just making the payment in 26 subject to the limitations. So you do have to run some numbers, run some models. Everyone's situation is a little different. But even after 2025, the traditional bunching strategy remains, meaning you may want to bunch 3 years of charitable contributions into 1 year, maybe use a donor advised fund so that you itemize in the year you bunch your contributions, and then you claim standard deductions for the next 2 years. This sort of bunching strategy has worked for many years now. It can even be more beneficial now if you're also avoiding that annual 0.5% haircut. The next slide is QCDs. This is not new, but always something important for donors at age 70 and a half or older to consider. You can make direct charitable contributions from your IRA directly to a public charity, and the IRA distribution will be excluded from your income. So an exclusion is generally, almost always more beneficial than a charitable deduction for a variety of reasons. And the QCD does offset the RMD. So if you are limiting your IRA distributions to just the required minimum distributions and you're making charitable donations, you definitely want to consider doing QCDs with those RMDs. So you can discuss this with your KSM contact, but you'll need to discuss with your IRA custodian as well, because it does have to be direct transfers from the IRA directly to the public charity. And finally, we just want to put a reminder in here to always consider donating appreciated investment assets instead of cash. You want to consider this with capital gain property, and it works particularly well with publicly traded stock because it is easy to value and you don't have to get a qualified appraisal. But in any event, if it's capital gain property, meaning the sale of the property would generate capital gain income, not ordinary income, this can allow you to avoid recognizing the capital gain income, but still provides a charitable contribution for the full fair market value of the property. So it can be very beneficial to exclude the capital gain and get your charitable deduction by using capital gain property instead of cash. All right, that was a quick overview of OBB's impact on charitable giving, some things to think about before year end and into the future. I am going to turn this over next. Stephen Schnelker, OBB, also has an impact on estate and gift planning and the new Trump accounts. So we're going to turn it over to Stephen. He's a director in our tax services group to discuss those impact on estate and gift planning. Stephen?
Thank you, Ryan. So before we get started here, we'll go ahead and do code word number 7, and that is 849. All right, so as part of the OBBB, the estate exemption was made permanent at $15 million per individual, and that starts on January 1st, 2026. This is indexed for inflation. Now, I say permanent, it's as permanent as any tax provision is. Congress could always come back in and change that at a later date. But unlike the previous TCJA, there is no automatic reversion that would reduce the exemption. So that does provide some time for executing our estate plans. However, most estate tax planning is really predicated on excluding future growth from a client's taxable estate. So really, the most bang for your buck is going to still be to execute your strategy sooner rather than later. And if you read the news, there is a lot of talk about this $15 million exemption, but I would be remiss if I didn't talk about state level estate tax. Here I have a list of all the states that have the estate tax, and it may be less than the $15 million federal amount. For example, DC is around $5 million. Illinois has a $4 million exemption. Minnesota, $3 million. And I can't forget our friends in New York, where it's approximately a $7 million exemption, so long as you don't exceed the exemption amount by more than 5%. If you exceed the exemption amount by more than 5% in New York, your exemption goes away and you are taxable on 100% of your estate. I will also say we have to be mindful of how the estate tax works for non-residents. So for example, we said that Minnesota has a $3 million exemption, but it could be, and we had this come up with a client recently, that, you know, if they have $1 million, maybe a $2 million property in Minnesota, you might think, well, I'm doing fine. There's no Minnesota estate tax. However, the Minnesota exemption was prorated based on the value of the Minnesota property versus the entire gross estate. So even though the individual property was under the Minnesota exemption, it still they still had a bit of Minnesota tax due on their Minnesota estate tax return. So just something to keep in mind, that there's still lots of planning that needs to be accomplished for even though the federal exemption is more than $15 million. But what about for our clients who are what has been termed the middle rich? So these might be clients who are married couple who has less than $30 million. Well, first and foremost, what we need to do is review the estate planning that they've already done to make sure that it still works. And the example I have here is we had a client a couple years ago who set up their estate plan, and it was wonderful. And at the time, the exemption was around $3 million, and their documents said, upon the death of the first spouse, that they were going to give the kids the maximum amount that could have passed without estate tax, and then give the rest of it to the spouse. Well, lo and behold, they the first spouse passed away after TCJA, and their whole estate was about $10 million. So according to the document, the kids were supposed to get 100% of the estate, leaving nothing for the surviving spouse. And so we just want to make sure that whatever planning is done, that we get these updated, that it's at least reviewed to make sure that we don't have issues like that. With that, in that case, it was able to work. They were able to work out a plan with the spouse challenging being disinherited. Everyone was friendly. They came up with an agreed upon solution. So what else can we do besides reviewing documents? Well, if your clients aren't worried about the estate tax, well, maybe we can help them with some income tax planning. And how do we do that? Usually that's by helping them achieve a basis step up. And so the ways that we can do that, here's a few of the tools that we have. This is by no means an exhaustive list, but if assets are in a trust, is there a way that we can use the powers of appointment, whether they be the most likely limited or general powers, but can we use a limited power of appointment to appoint the assets to someone who does not have a taxable estate, so that they could get a basis step up? Another option might be to decant the trust. So maybe there is no general power of appointment because when it was set up, we were trying to bypass estates, set up some type of dynasty trust. But could that be decanted now to give a general power of appointment to someone who will not have a taxable estate, so that upon their passing, the assets within the trust can receive a basis step up? Remember, it doesn't have to be a general power of appointment, doesn't have to be exercised solely by the power holder, right? It can require the consent of a non-adverse party in order to exercise that power. So could we decant to a trust where it has a sufficiently limited general power of appointment? The other option might be upstream gifting, right? So maybe you have maybe there's a G2, a second generation that's extremely wealthy, but G1 might not have a taxable estate. So could G2 somehow gift assets up to G1, and then have those, when G1 passes, have those assets receive a basis step up? Remember, though, under 1014E, if the same person who gifted those assets receives them back within a year, there is no basis step up. And same idea down here with this GST planning. Are there assets out there? Was there GST planning done previously that might not need to be in place now, right? So maybe the kids won't have a taxable estate with the $15 million exemption, so it might be beneficial to include those trust assets in their estate for the basis step up purposes. And so, another thing we always want to keep in mind is our annual gifting. So we have here a list of several various types of gifting accounts. Each of them have their own pros and cons. I'm not going to read everything on this slide. It'll be available for you with some considerations for each of these types of accounts. And really, it's just trying to marry how much control and how much flexibility does the donor want with respect to the assets that are gifted. Real quick, I just want to touch on Trump accounts because those were in the OBBB. These can't be funded until July 4th of 2026. And so we're still waiting for additional guidance on these accounts. For me, the most important guidance that I would like to receive is whether gifts to these accounts qualify for the annual exclusion for gift tax purposes. Because if you a literal reading of the rules would seem to suggest that they would not qualify. And so if a parent, for example, contributed $5,000 to a Trump account for the benefit of their child, they might be using $5,000 of their lifetime exemption as opposed to $5,000 of their $19,000 annual exclusion. So we still need more guidance on these. Again, they cannot be funded until at least July 4th of 2026. Hopefully that guidance comes out shortly. And lastly, I just wanted to highlight and remind people of the changes under the OBBB for 529 plans. Again, Congress has tried to make these 529 funds more available. And so this will, again, just might be another reason why we want to favor some 529 plans, as we're not as concerned about the money being, quote, stuck within the 529 plan. Congress has allowed more qualified distributions. Now, I will say you got to be careful about your states. If you receive a state tax benefit for contributing to a 529 plan, you need to check with your state to see if these additional uses of 529 plans, 529 funds, causes an issue or a clawback for your state tax benefit. And with that, we're going to kick it back to Ryan.
Great, thanks, Stephen. And certainly more to come on those Trump accounts. We're still waiting for the guidance and the uses and benefits of those accounts, but stay tuned for more on that. Next, we're going to move over to Alex Zarinsky. Alex is a director in our tax services group, and he's going to give us a little refresher and overview on the deductibility of meals expense and a change that really originated from TCJA all the way back from 2017. We have a 2026 change lingering from that law. So, Alex, turn it over to you. Okay, code word is on the screen. Code word number 8 is 687. Code word 8 is 687. Alex, are you there?
Yep, I'm here. Thanks, Ryan.
Gotcha.
So yeah, as Ryan said, this is really not an OBBB change. This is a TCJA change that just had a delay start time. So kind of the spoiler for this going in is that TCJA had a delayed start for this 2026 provision that said that 119 and 132 certain 132 expenses were no longer deductible by businesses. So we just kind of want to take a step back and go over what are the general deductibility rules, what is 132, what is 119, to make sure that those rules make sense going forward, especially since there's been a lot of articles out there that have been a little bit confusing or misleading about general just blanket disallowance of coffee or snacks. So we want to kind of go over those rules in a little bit more detail. So to start with the pre-TCJA rules. So some of these are the same, but let's start with what 274, 119, and 132 are. So 274 is a business provision that allows businesses or employers to take deductions for food and beverage expenses. 132 and 119 are both on the opposite side of things. They're still food and beverage provisions to some extent, but they talk about when an employee or a contractor would have to include food and beverage provided by an employer into their income. So they're kind of related, but they're not exactly the same. So it's important to know the differences. So to start with 274, there's a general disallowance. No food and beverage are deductible unless we meet an exception. And there's a long list of exceptions there. We're not going to go through everything here because we certainly don't have the time. However, most important for this conversation is there's an exception for food and beverages furnished on the business premises, primarily for employees, and there's a deduction available for expenses that are treated as compensation. And those are kind of the ones that'll interact here, but really these other ones will kind of overrule those exceptions to some extent. 274 also says that in general, any food and beverage expenses that are deductible at 50%. However, they provide exceptions to that 50% deduction for things that are 100% deductible. So for example, expenses treated as compensation are 100% deductible. That makes sense. We buy food and beverages that are in compensation that's going into W-2. That's really compensation deduction at 100%. Really not a food and beverage expense. Items that are sold to customers. So if you're a restaurant, you're going to sell customers, you can obviously deduct those expenses. So those are things that are 100%, whereas typically if you go out to dinner with a client or a prospect and you try to deduct those expenses, they'll be limited to 50. So the part of this adjustment that comes in is one of those exceptions for 100% deductions prior to TCJA said that food and beverages that were excluded from the employee's gross income under 132E was 100% deductible, which brings up the next question is what is 132E? So 132 just talks about all fringe benefits, and specifically 132E says that they define de minimis fringe benefits and say that property or services that are so small to make accounting for it unreasonable or administratively impractical are de minimis fringe benefits. They're not included in an employee's compensation. That makes sense. If you have a coffee pot out for the office, there's no way for you to really practically track who's drinking coffee and how much and include it in their that employee's W-2. So they say that's not W-2 wages. And the pre-TCJA 274 said that those expenses would be 100% deductible. I should also mention here that because it'll come up a little bit later, that 132E2 has this definition of an eating facility in talking about deducting those as de minimis. So this will come up for pre-TCJA. The eating facility part really never factored in, but now with this rule beginning in 2026, it does factor in. So it's worth saying, what is an eating facility? We don't have to go through all the definitions, but I think that really the most important things are that it's essentially a cafeteria or a dining room. It has to be located on the business premise or nearby, operated by the employer. And it has to be really, courts and the IRS have acknowledged that it has to be set aside for preparing and/or serving meals and the consumption of meals. Really what's important there is that it's not a snack area. So, for example, if you have a room that has a coffee pot, some waters, bottles of water, some snacks, and a printer, no seats, no tables, the IRS has clearly looked at situations like that, and courts have, and said, well, that's a snack area. Snack areas and employee desks aren't eating facilities. They're not designed to eat there. There's no tables. There's no one there to prepare or serve meals. Those aren't eating facilities. So that's important to remember when we get into the next adjustment. The other part of this that kind of factors in is going to be 119. So 119 is different. It was never specifically mentioned in 274. So theoretically, it was not specifically mentioned, I said. So theoretically, 119, well, practically 119 allows meals furnished by a business on the business premises for the convenience of an employer to be excluded from employees' compensation, which makes sense. So for example, if I'm required to be at the office between the hours of 9 and 2, and I have to be at my desk in case an emergency call comes in, think of a 911 operator type thing. Well, I can't go out and get a meal, so my employer gives me a meal. They're saying that that's not compensation to me. That is going to be for the employer's benefit, not for my benefit. So because it wasn't mentioned in 274, prior to TCJA, we would have said that's generally 50% deductible because of that exception I mentioned earlier that says that when an employer provides food and beverage on the business premises, that's a deductible expense. That would have been deductible at 50%. However, if you said that that's actually a fringe benefit, again, that'd be facts and circumstances based, you might have been able to get up to 100, but that was basically the general rule. The second part here that's important to think about in 119 is what is really for the benefit of the employer. And how that's included, I gave an example of like a 911 operator. You have to be at your desk. The regulations give several examples kind of similar to that, but really it comes down to facts and circumstances. Is the meal a compensatory or a non-compensatory benefit for the employee? So if it's not compensatory, if I'm required to be here and you're giving me food so I can sit at my desk and answer this call, then it would be a 119 expense. If it's compensatory, so specifically, the regulations say that if a meal is provided to an employee to promote morale or goodwill of the employee, or to attract prospective employees, that's deemed compensatory. So theoretically, in that situation, you're providing a meal and it's just to provide goodwill. That would be compensation to the employee. The other piece here, I said in the slide here, it says the key provision, but the one other thing I should note is that this has to be a meal. So courts and IRS have looked at this and said that, meals are prepared, combined ingredients for breakfast, lunch, dinner, supper, things like that. Snacks and coffee and water are not a meal, so they would not be 119 at all. All right, going through all of that, we go to the TCJA change. So like I said, they originally, when they first passed it, they removed 132 from the 100% deductibility rule. So all that did was in 2017, when they passed that meant that going forward, those snacks, those fruits, the coffee, the water, instead of being 100% deductible, got dropped down to 50. Really no other change at that time. However, we have this delayed effective start date as of January 1st, 2026. They added a new section in that says no deductions shall be allowed for any expense for the operation of a eating facility in 132E2. So we're talking about dining rooms and cafeterias. And what we're talking about today, no deduction for food or beverages, including those under 132E1 that are associated with an eating facility in 132E2. So they're not saying all food or beverages that are snacks, coffee, water, things like that. They're saying those that are associated with a cafeteria or a dining room or something like that. So it's not a blanket exclusion on coffee, snacks, water. That's not how it's worded. The other part of that is they said there's no deduction for meals described in 119A. So those are the meals that we were just talking about, how they're for the benefit of the employer and on the employee's premises. So really what we're saying here at the end of the day is that if you have compensatory meals that are meals for employee morale, those are going to be compensation. They'll be 100% deductible. If you have non-compensatory meals, if they're for the benefit of the employer, they're excluded from the employee's wages under 119A, but they're not going to be deductible to the employer at all. If we're talking about snacks, coffee, the de minimis expenses, we have to have a two-part analysis. One is it associated with an eating facility? If it is, then it's going to be a non-deductible expense. If it's not associated with an eating facility, we'll still get that general deduction at 50%. So those are kind of the summary of what changed there. And I'll put it back to Ryan to go keep this moving.
Great. Thank you, Alex. Appreciate the overview of meals expense. They don't let anything be easy, do they? So, all right, we're going to move to Stephen Royster, is a partner in our state and local tax group, and Crystal Schultz is a director in our state and local tax group. So we've been having a grand time so far talking about federal tax changes. Stephen and Crystal are here to remind us that the state considerations are also very, very important. Stephen, off to you.
Yeah, thanks, Ryan. Not to be forgotten, state tax implications. Oh, and before we do anything, we have code word number 9926. Code word number 9926. All right. So the OBBB is more than 4 months old, and we've started to get some responses by state. But before we get into that, I thought it might be helpful to explain a bit about like why the OBBB matters for state taxation. So almost all the states start with some component of definitions or calculations from the Internal Revenue Code. So in the state and local tax world, we refer to this as conformity. So conformity to that Internal Revenue Code. It's very similar to how KSM will take a company's book income and calculate book to tax differences to arrive at federal taxable income. Same thing really happens to come up with your state taxable income. States will generally start with that federal taxable income, and depending on conformity, make adjustments to arrive at state taxable income. So that's why it matters. So you may have seen this slide before if you've attended one of these meetings before, but just really looking at internal revenue code conformity by state and how the states adopt it. So we really have three methods of adoption. There's static conformity as of a specific date and time they conform or do not conform to the Internal Revenue Code. There's rolling conformity, which means to the extent any change for federal tax purposes happens, then the state is an immediate adopter. And then you have those that kind of pick and choose, and we call those hybrid or kind of a selective. So the biggest item here to me is really the states with that rolling conformity. So as you can see, there's a lot of rolling conformity states, but depending on whether or not we're talking about corporate or individual tax law. So those are the states that have already effectively adopted the OBBB tax implications in their starting point, whether they wanted to or not. And so those are the ones that are really going to have to evaluate whether or not economically they can handle the changes that occurred. So real quick, and this slide can be brief, but just to give you an example of what static versus rolling looks like. Static basically says, hey, none of the changes for the OBB have been taken into account with respect to Ohio. You'll see the second bullet talks about 163J. It's coupled to former 163J, but any changes relative to the OBBB would not necessarily be come in there and have any sort of implications. So Ohio's probably going to have to address whether or not the leniency with respect to the new 163J count is something that they want to stomach. Same thing really then when you look at New York. Oh, and there's a spelling there. With respect to New York and having rolling conformity, and basically all the changes, again, of the OBB were taken into account in New York. And so you also notice that it's decoupled, New York is decoupled from bonus depreciation or 168K. So that's a previous decoupling. So any changes there are not something that that New York's going to have to deal with. But all the other changes are effectively in the starting point for New York. So really, the thing we want to address here is there's just a lot of uncertainty, not only from a federal standpoint, as you've already heard, but also from a state standpoint. We've been talking since July about states making changes to their laws. And the reality is most states don't have a full-time legislative body to address these issues. In fact, the vast majority had already adjourned for the year by the time the OBBB passed. So any changes now require a special session. And so that's just not something we see states do a lot, is to call a special session, but you'll see in a slide or two, they are. So that all goes to say, we expect a lot of activity in the first and second quarter of 2026. So this is the reason when we think there's going to be a lot of activity. So when we think about the actual tax dollar implications, these are numbers states have thrown around, and New York might as well say gazillion behind it because it's so much bigger than everyone else's. But the reality is it's going to cost money. I mean, the flip side of that, though, obviously, flip side of that is if it's going to cost the states money, that probably means less tax for businesses and individuals. So two sides of that, depending on where you are. But we all know what it means to decrease a budget and how states and businesses and people do not like to decrease budgets. So these are some of the states that have already updated their Internal Revenue Code conformity. And again, we're talking about not all of these are rolling conformity, but some are. But they've gone from that rolling conformity where they would have just included all the state, all the OBBB changes into their starting point. Now there's going to be a consideration as to whether or not they want to adopt those things. So I don't know that this speaks to all these states will definitely have other decoupling modifications or other coupling modifications to the OBBB, but I think they wanted to almost just stop the bleeding, if you will, and get a sense as to the implications from the OBBB before they adopted any of those provisions. My slide is not advancing. So as we're thinking through this, there's obviously going to be operational complexities with respect to the OBB. And so honestly, a lot of people on this call know more about that than I do. But just with respect to overtime tips, kind of the management component of some of the complexities, healthcare, I mean, there's a lot of stuff in there. I think from our standpoint, just understanding that there's going to be state tax complexities as well. So if all of a sudden, and I'm not saying this will happen because I don't know, but if those 20 or 25 states start to decouple from the Internal Revenue Code, now all of a sudden you have a whole lot more of those potential state tax adjustments that are going to have to be evaluated. So I'm not trying to be chicken little that, oh, my job just got a lot harder, but it potentially could. Just due to complexities. Historically, in a state where there was complete coupling to the Internal Revenue Code, now we have to give consideration as to what adjustments might actually exist there. But I think kind of one of the hidden values of the OBBB is that all of a sudden we have certainty from a federal and state standpoint. So I think certainty is very valuable in the world, helps us to plan around, helps us to know what to do. And so when we think about pass-through entity tax elections, when we think about the whole SALT cap and whether or not that's going away, we know for certain, in the near term that it's going to be there. So is there planning available that we can utilize, that we can put in place just to receive some level of tax benefits? So to summarize, the state tax implications due to the OBB are really a moving target, and it's just yet to be seen if there will be a similar net tax benefit at the state level as is indicated from the federal, from the Internal Revenue Service, from the federal government. So stay tuned as we expect continued changes in the coming year. There will be a lot of changes. I'm almost certain. So with that, last but definitely not least, is Crystal to talk through some sales and use tax topics.
Thank you, Stephen. So we are going to go through some sales tax trends, traps that we're starting to see across the US, or what we've been seeing through 2025. And states are using sales tax more strategically than ever right now to both replace lost income tax revenues and to try to keep up with the rapidly evolving digital economy. So let's start with the bigger picture. Many states are using sales tax to offset these reductions in the other tax areas. For example, corporate or individual income tax cuts. And then by broadening that sales tax base, the states are raising more revenue at lower overall rates, and they're doing it across a wider range of consumers. So putting it into that consumption tax instead. Ultimately, the base expansion trend allows those states to maintain fiscal stability, and they're still advertising those income tax reliefs, right, to the residents, to the businesses. But as we all know, at the end of the day, the states are going to have to get the revenue from somewhere. So we're continuing to see a push to expand what's considered taxable. So we know things are already subject to sales tax across most of the states. But to give you an idea, in 2025 alone, 13 states introduced 34 separate bills aimed at broadening the sales tax base. So the goal is neutrality, it's efficiency. It's, like I said, trying to tax that final consumption more consistently rather than maybe exempting an entire industry or a service sector. And services remain one of those most active battlegrounds for base expansion. So a few of the examples as they're listed here, we saw Illinois this year introduce new rules around leasing and renting tangible personal property. We saw Maryland expand taxation to include IT and digital services. North Carolina is taxing rideshare services now. And, Washington expanded all sorts of additional taxes from a taxable service standpoint. So the one thing to remember, as I said, sales tax historically taxes the tangible items. In order for a service to be subject to sales tax in a state, it must be enumerated in the statutes. So you're going to see it different across every state, and that's why. It's going to come back to what is enumerated specifically in their statute, indicating that those specific services are subject to the sales tax. And I want to highlight that software as a service and digital goods and services is probably the single biggest area of change over the last year, and it will continue. States are struggling to keep pace with the tech sector's growth. The statutes are way outdated, right? We still have landline telephone statutes. So it's going to take some time, right? I don't know that they'll ever catch up entirely, but they're trying to be a little bit more broad. And now many of those states are choosing to tax digital transactions, just like the tangible goods. So, for example, Louisiana enacted digital goods taxable January of 2025. Maryland, as I said on the last slide, IT, digital services, all of that is including software as a service, data hosting. That took effect in July of this year. And then Washington broadened even bigger as far as what they're taxing for services. And it goes down to all services that are delivered digitally. And that includes now digital advertising services. That took effect October 1st. And like I said, expect this trend to continue to accelerate as digital transformation continues. And right now, I think more than half of the taxing jurisdictions are taxing software as a service. So as we continue to broaden the base, another way to increase sales tax is rate increases. So that's another part of the trend we're seeing. The state level is slowly increasing, I'd say, but more common, we're seeing a lot of local level increases. So just to kind of level set the taxable rates across the US, there's more than 14,000 different combined sales tax rates. In the US today, 45 states and DC impose a state level sales tax, and of those, 38 allow local jurisdictions to add their own local sales tax. So you can understand that by itself could impose definite challenges to a business as you're trying to keep up on the ever-changing rules. And then just to add to the complexity, another challenge is those local levels can also have different taxability or exemptions. So 2 examples, as we were just talking about the software as a service, the state of Colorado and the state of Illinois do not subject software as a service to sales tax, but Chicago does. And then the Colorado locals, Denver, Colorado Springs, the locals all subject it to sales tax. So you don't even have consistent taxability across a state level jurisdiction. So you have to go down to even the local levels to understand or to investigate if something would be taxable or not. So that's where all the traps come in, right? And then speaking of trends, there's no more penny. Now what? Now what are we going to do? As the penny is no longer being minted, which I'm sure most of you have heard or seen in the news, makes sense, right? From a business sense, when you're producing something that's worth 1 cent and it costs 4 cents to produce it, that makes sense. But who would have thought it would have a drastic impact on sales tax and on retailers? It is, and it will be a mess. I'm not going to sugarcoat it. Ultimately, it's forcing a move away from penny-based rounding rules. And now the next most accepted method for rounding is going to be to the nearest nickel. But that raises equity concerns, especially because there are strict equal treatment laws nationally around cash and credit transactions having to be equal. So if you're rounding in a cash basis, but if I use my credit card to pay for something, it's still going to be to the penny. That could cause some challenges and some complexities. Not to mention POS systems are going to need to be updated. Pricing models may end up needing to be changed at the retail level. And retailers may even end up absorbing some of this sales tax burden now when filing returns based on how the sales tax has historically been collected and filed. Because there's rounding happening in every transaction and every filing. So it's just going to be really interesting as we see how this progresses. And just last week, a New York senator introduced a bill that is called the New Yorkers for Common Sense, CENTS Act, which is clever, right? So there'll be some cleverness around, I think, some of these acts, but that bill would require vendors to round the cash purchases to the nearest 5-cent denomination. So they're standardizing how those cash transactions are handled. And that's at least what New York is pushing to do or trying to do. So each state is going to have to go state by state to enact guidance around this. So eventually we'll see that. But for now, consistency in the methodology at the retail level, at the business level, is going to be key. And from my own personal standpoint, I think it's only a matter of time before it's determined that it's really not economical to produce the nickel. Because fun fact, it costs 14 cents to produce the 5-cent nickel right now. So where's that going to lead down the road? But stay tuned. Keep your eye out on that. I think you'll be seeing a lot more of that in 26. Maybe as much as the OB3, right? All around the penny. So moving on to some tips and tips to avoid traps. So as we're talking about sales tax trends, we're of course going to have at least 6-7 sales tax things we're going to be talking about. Those of you that have teenagers fully understand that, as I do. So the first one we want to make sure you're looking at, and this isn't just year end, this is something that should be part of your standard business kind of review wherever it fits into your cycle. Maybe not even just annually, ideally, but you want to be reassessing your Nexus footprint regularly. Nexus has both physical presence, it has economic nexus. Won't get into that in the details today, but just something that you really need to be aware of where you have the requirements to be filing sales tax among the different states. And their rules are also changing. You know, they're going away from some thresholds of transaction counts and maybe just focusing on dollars. So definitely something to keep aware of and watch as your sales into new jurisdictions are increasing. The other thing you want to be mindful of is reviewing your use tax self-assessments. So make sure you have a process, number one, and two, it's a good time to take a look and see at least at your fixed assets, if not everything else from a process standpoint, before you get that last return in for the year. See if there's anything that was missed. If you do have a really solid process, just double check, take a look. Understand and update those internal processes throughout around sales and use tax. The one I want to spend a little bit of time on is sales tax software. There's some really great tools out there as your businesses are expanding their Nexus footprint. You're having to file instead of just the one home state jurisdiction. Maybe now you're up to 40, 45, all the jurisdictions, or half of those is still a big undertaking for your business. And you employ sales tax software, one of the many different options. You want to make sure that it's doing what you think it's doing. It's not just plug and play. It needs to be reviewed and make sure that it's filing all the returns you're required to file as well. So make sure it's set up to where you're registered, double check that those returns are being filed. As another example, is it filing the Washington combined sales and B&O tax, excise tax return? It's one return. Or is it really just kind of stripping that out and filing just a sales tax return? I've been seeing that a lot this year, a lot more than in the past years. So something we want to take a look at, make sure that we're filing that combined return. Trying to avoid the states coming to us, right, to try to be ahead of the game. Also want to make sure that that software is coded to the products that you're offering. We don't just want it to be blanket taxable that we're selling stuff, especially as the taxability of those services expands. We want to make sure that the software is catching it when those states are expanding their taxability. So really important to have it set up appropriately and very specifically, as specific as you can. And then the other thing that I think is important to mention is make sure that as a business, if you do have software that's filing your returns for you, they're paying the tax in for you, essentially everything is automated and you've been hands off, you still want to make sure that you have state portal access, that you can log in whenever you want to go in and monitor within the state portal itself that there's no notices hanging out there that may have been sent to the software provider, that there's no outstanding balances, late fees, that everything is working as you think it should be. So really pay attention to that software and dig in to make sure it's doing what you think it's doing and what you're paying for it to do. And as you're expanding, whether you have software or not, you want to be reviewing the taxability of your product offerings. If you have some new product offerings that you're rolling out, make sure you dive in a little bit deeper and figure out that you're taxing them appropriately, and keep those exemption certificates up to date across all states. Maybe you are a manufacturer and you don't necessarily file in a state, but by Nexus requirements, you should be. Get those exemption certificates up to date at least. Make sure you've got kind of the support should the state start asking questions so you don't have to go recreate the wheel later is really important. And then make sure you're filing accurately in all your required jurisdictions, which kind of encompasses everything, right? So overall, sales tax compliance has become, one of the most dynamic areas, I think, within state taxation. I think for sure it has. But proactive monitoring can go a long way towards avoiding costly surprises down the road, whether that be audit or, Nexus questionnaires, things like that. We want to be ahead of the game and use the tools you have to your advantage, so there are at least as many of those surprises avoided as possible. So back to you, Ryan, to go through some of the other items.
Okay, first we got code word number 10. Code word number 10 is 968. While we got the code word up, thank you to Stephen and Crystal. The state and local tax considerations are okay, great. Are very very important to remember. So code word number 10 is 968. Code word number 10, 968. All right, thank you, Crystal. Great. So additional topics. We've gone over 2 hours here talking a lot about OB3 and the provisions and the impact on it. And we've tried to focus on some of the biggest items, the most impactful, the most, broadly applicable. If we were to try to cover every provision that was in OB3, we would have to go another 2 or 3 hours. There are a lot of provisions in there. But what we're going to do now is we've got another 5 slides or so of additional topics we want to hit on. And then we've got a bunch of slides that I'll explain later that we're going to just kind of leave as references for you. So first up on this slide, it has a miscellaneous section of 3 topics on it. And the most talked about by far is the SALT cap, that first row on this chart. This was a major point of negotiation between lawmakers as they were trying to craft a bill that they could pass. Some wanted to see the SALT cap increased versus those that didn't like the cost of it. But what is it? What is the SALT cap? This refers to the threshold that limits an individual's itemized deduction for state and local taxes to $10,000. It also applies to trusts, but most of the discussion centers around the itemized deduction of individuals. And there was a lot of discussion, a lot of back and forth and various proposals. with respect to the SALT cap, lots of media coverage. And where did it land? And again, this is with respect to the OB3 that was passed in July. They landed on a temporary increase from a $10,000 cap to a $40,000 cap. And this is effective for 2025 with small inflation adjustments through 2029, and then reverting back to a $10,000 cap in 2030. So we have 5 years with an increased SALT cap. However, the increased SALT cap does start to phase out when modified AGI exceeds $500,000 and phases all the way back to $10,000 when income exceeds $600,000. So high income taxpayers, those with over $600,000 of income for the year, will not benefit from the increased SALT cap. So you got to keep that in mind as you're planning ahead. And those between $500,000 and $600,000 will have a cap that's somewhere between $40,000 and $10,000. So, and I'll note these amounts. These include the overall cap. These amounts, including the overall cap, are all halved for married filing separate taxpayers. So one important takeaway is that high income taxpayers may not benefit from the much publicized SALT cap increase. Another takeaway is for those taxpayers that will benefit, if they've claimed the standard deduction in recent years, this may result in going back to calculating and claiming itemized deductions. So you may need to tighten up records with respect to charitable contributions and maybe even rethink the timing of Q4 state estimated payments. You want to make the Q4 payment in December or January, depending on what you think you may benefit with respect to this potential increased SALT cap. And I do have a bullet point here that says no new limitations on PTET deductions. I won't go into the details since we ended up with no change. But for anyone out there that was worried about the various proposals to limit or disallow PTET deductions, none of those proposals made it into the final legislation. So it's business as usual for PTET deductions. Those are the regimes that allow pass-through entities to pay the state taxes at the pass-through level to get a federal deduction for those state taxes. And those federal deductions are not subject to the SALT cap. Next is QBI. QBI is the extremely important 20% deduction regime for pass-through entity structures. The deduction was scheduled to expire after 2025, which would have had a dramatic impact on the taxation of flow-through structures. But the 20% QBI deduction is permanently extended now, and it has even been expanded a little bit by increasing phase-out or phase-in income limitations and providing a minimum $400 deduction in certain cases. So the new QBI modifications do not apply for 2025. Those modifications are for 2026 and beyond. But the general QBI deduction that we've had since TCJA is now permanent. It is not scheduled to expire anymore. And the final topic on this slide is excess business losses. For those of you that were worried about proposals that would make the carryover losses more difficult to utilize, none of those proposals made it in the final legislation. The EBI limitation is permanent now, and the limitation threshold is increased for inflation. But otherwise, the carryover losses continue to convert to NOLs in the carryover year. So pretty much business as usual for those of you dealing with excess business losses. Okay, I threw this slide in. We've talked a lot about tips and overtime already, but I did want to just briefly mention the new deduction for interest paid with respect to loans for personal vehicles. So this is a brand new thing, temporary for 2025 through 2028, but it allows individuals, this is an individual level deduction, just like the tips and overtime, to claim a deduction of up to $10,000 on interest paid on loans to purchase new personal use vehicles. And this applies only to new loans, and it applies to only certain vehicles that are assembled in the US. So you got to be careful on whether the vehicle qualifies or not. But I'll also note that the phase out begins at $100,000 on a single return and $200,000 on a joint return. So The phase out is a pretty low phase out threshold, and the deduction is capped at $10,000. But there is a new deduction out there for interest expense on personal vehicles. And I'll also note that if you're in the business of receiving interest on these loans, there's a reporting requirement to issue a 1098 to the individuals who are paying this interest. But the service did provide relief for 2025, much like the reporting for tips and overtime. For 2025, instead of the formal 1098, 1099 reporting, people who are receiving this interest income can just report it informally as a statement, as a portal, an email, something like that, for 2025, and then you would expect full reporting in 2026. So that's the new deduction available to individuals for car loans, and it's new loans starting in 2025. Okay. Wanted to mention just briefly the employee retention credit. Hopefully we're about done talking about this thing. But there was an important retroactive termination in the OB3, which is for refund claims filed for the third and fourth quarters of 2021. If those refund claims were filed after January 31st of 2024, so if you've got any of those refund claims pending for the third and fourth quarters of 21, and you filed those claims after January 31st of 2024, those claims are going to be denied. Essentially, the ERC was retroactively terminated for those claims. So if you've got that claim pending, you would expect that claim to eventually be denied. There's also increased statute of limitations and some additional punitive rules for those ERC promoters that were kind of helping taxpayers with too aggressive a position on some of these ERC claims. So, but the big thing is those refund claims for the third and fourth quarter of 2021, check the timing on when those were filed. 1099 thresholds have been increased. So this is kind of welcome news. I feel like the threshold's been $600 since as long as I can remember. But starting in 2026, the general reporting threshold increased from $600 to $2,000. So 1099 miscellaneous, 1099 NECs, backup withholding. And again, this is effective for payments made after 2025. It's going to be adjusted annually for inflation starting in 2027. But for anyone dealing with 1099 reporting and issuing 1099s, that $600 threshold is going to increase to $2,000 in 2026. And I don't know if anybody out there is dealing with these 1099Ks, but the threshold here was restored to 20,000 plus 200 transactions. There was a period of time where the 1099K threshold was much lower. We had a lot of people receiving 1099Ks for personal transactions, ticket sales, things like that. Didn't really make any sense. But the OB3 did restore the 1099K threshold to $20,000 plus 200 transactions. And this retroactively applies for all of 2025. Just a quick mention, there was some commentary about it. President Trump did issue an executive order March 25th of 2025 that is requiring payments and refunds with respect to Treasury and other government agencies to eliminate and phase out the use of paper checks. There was some concern that, and he set an effective date in that executive order of September 30th. And so there was some concern about come September 30th, will taxpayers be able to make tax payments using checks and things like that? It was quite unknown after this executive order was issued. But there was an IRS news release issued September 23rd of 2025 And that news release makes it clear that the first phase towards implementation of this executive order, the first phase is focused on individual refunds only. So if you're filing a 1040 and claiming a refund, you want to include the direct deposit information on those individual returns when they're claiming refunds. The government has said they want to avoid issuing paper checks for those refunds. Now, I said it that way because it's not clear what will happen if you don't include direct deposit information on those individual returns. The news release indicates they may send a letter and request the direct deposit information. We'll see, but the first phase of trying to implement this executive order is focused on individual refunds only. So there's no change yet regarding the use of paper checks to make payments. So if you're making payments and you want to make it with paper check, so far so good on that. There's no change or no new restrictions with respect to making your tax payments using paper checks. Of course, IRS direct pay and other electronic payment options are very good alternatives to start using just from a convenience standpoint. But for now, the use of paper checks is still available. But those 1040s claiming refunds, we need to try to include direct deposit information on those. Okay, we're in the final stretch. So the rest of these slides are really in here for your reference purposes only. We do not intend to go through these slides in any great detail today. If there's anything in this slide deck, so you're going to receive the slide deck after the presentation. If you go through the rest of these slides and there's anything that you're dealing with or anything that sparks your interest, you can reach out to your KSM contact or myself or any of the presenters to discuss them. But the first series of slides here is OB3's impact on international tax. So just quickly, for those of you that have foreign corporations in your structure, you may be used to dealing with what we call GILTI. These are anti-deferral rules that require inclusions when you have a controlled foreign corporation in your structure. They've changed the name from GILTI to net CFC tested income. I think we're still calling it GILTI for now. But then they've made some changes here, and most notably is they've taken away the deduction for 10% of the QBAI. So for CFCs that are capital intensive, have a lot of fixed assets in place, this could cause an increase to your GILTI inclusion. But they also relaxed the rules with respect to the foreign tax credit. So you could have an increased inclusion, but an increased foreign tax credit. There's going to be some winners, some losers, some pushes. The numbers will be all over the board. FDII modifications. So again, they changed the name here, but this is an export incentive for U.S. C corporations only. So U.S. C corporations that have export sales can benefit from what we call an FDII deduction. And again, they've made some changes here as well. You'll notice the QBAI is on this slide. Here, the elimination of the QBAI deduction is a benefit because we want the highest possible foreign derived income that we can get to maximize those benefits. So there's some changes here to the FDII. Again, we're not going through these in great detail, but there's some legislative fixes in international tax. So the look-through rule, if you've got multiple CFCs in your structure, again, CFCs are controlled foreign corporations. The exclusion for firm personal holding company income, this is your investment income, interest, dividends, rents, royalties. The exclusion for these amounts received by from a related CFC is now made permanent. So it was scheduled, it's come and gone and expired and been restored. It's permanent now. And anybody dealing with downward attribution, You can't go into the details here. If you've had to deal with it, then you know about it. And there is some relief here effective for tax years beginning after 2025. The prohibition on downward attribution is restored, thankfully. Modifications to the taxation of CFCs. The timing of it, if you did not own CFC stock at the end of the year, there could be inclusions now for the portion of the year that you included it. And there's a deferral election that also was expanded or repealed, I'm sorry. Interesting change for the foreign source income rules. This comes into play for taxpayers that sell U.S. manufactured goods. There were scenarios where the sale of those goods would not constitute foreign source income, but this is a taxpayer favorable rule that allows for more foreign source income, which is a good thing. More foreign source income allows for more foreign tax credits. Couple things that were not in the bill made some headlines along the way, but again, these two provisions did not make it into the legislation. And energy credits, we're really not going to cover these today. You can see we're running short on time. But what I will say is that OB3 did make changes to the energy credits, and we're going to flip through a couple tables here. But the important takeaway is that if you're planning projects that rely on energy credits, it's good to revisit those, make sure those energy credits weren't changed, because a lot of the changes made by OB3 accelerated the termination of the credits or restricted the credits or otherwise limited the credits. So if you're involved in projects that utilize energy credits, you want to look at the credit you're using, and you can see here there are a bunch of slides. The termination dates are all changed and generally not taxpayer favorable. Yeah, a lot of energy credits. All right, we are in the home stretch here. So, okay, great. So I'd like to thank all our presenters for sharing this important information. And I'd also like to thank all of you for joining us today. We know there are a lot of webinars out there, and we appreciate you taking the time to be part of ours. If you'd like to reach out to any of our presenters, you can find the contact information in the slides that will be circulated after the presentation concludes. And as a reminder, if you submitted a question that was not answered, we will reach out to you directly. CPE certificates will be emailed in the next few weeks to those who entered the required number of code words. And please remember to check out of the Conference.io app to ensure your session is complete. And with that, thank you for joining us today. We really appreciate it and hope to see you at our next event. Thank you very much.